The mental game of investing is where almost all long-term outcomes are decided. Yet it is the aspect least discussed, least taught, and most frequently underestimated, because numbers feel objective, while the mind feels personal, and people prefer to believe failure is caused by lack of information rather than lack of inner discipline. The best investors understand a hard truth. Early markets do not primarily test intelligence, they test temperament. You can be analytically brilliant and still lose everything if your psychology collapses under uncertainty, volatility, and delayed gratification. At the core of elite investing psychology is acceptance of uncertainty. The best investors do not seek certainty because they know it does not exist in complex systems. Instead, they seek clarity about probabilities, risks, and consequences. This acceptance frees them from the emotional trap that paralyzes most participants, the need to be right. Once you stop needing certainty, you stop forcing decisions. And once you stop forcing decisions, judgment improves almost automatically. Many bad investments are not wrong ideas. They are premature actions driven by discomfort with waiting. Another defining mental edge is emotional asymmetry. Great investors feel gains and losses differently than most people. They do not experience euphoria from wins or devastation from losses. This is not emotional numbness. It is emotional training. They deliberately flatten their emotional response to outcomes so that results do not contaminate future decisions. They understand that markets reward consistency, not intensity. A single emotional overreaction can undo years of disciplined compounding. Fear, in particular, is treated as data, rather than an enemy. When fear appears, the best investors ask what kind of fear it is. Is it informational fear, signaling real risk, or is it social fear, the discomfort of being alone while others appear confident? Most fear in markets is social, not analytical. Elite investors train themselves to recognize this distinction because social fear leads to selling at bottoms and buying at tops, while informational fear can protect capital. This discernment is not instinctive. It is learned through repeated exposure to discomfort. Equally important is how they handle confidence. Confidence is necessary to act, but unchecked confidence is fatal. The best investors practice conditional confidence. They believe in their process, not their predictions. Every thesis is held lightly, constantly stress-tested against new information. When evidence changes, they change without humiliation or defensiveness. This flexibility is a psychological advantage because ego rigidity is one of the most common causes of catastrophic loss. Patience is often praised, but rarely understood. In elite investing, patience is not passive waiting. It is active restraint. It is the discipline to do nothing while doing nothing feels irresponsible. The best investors are comfortable with inactivity because they understand opportunity is not evenly distributed across time. Most days offer nothing worth acting on. This understanding reduces overtrading, overthinking, and emotional exhaustion. The ability to sit quietly while others feel compelled to act is one of the most profitable skills in investing. Another mental habit that separates the best is their relationship with boredom. High-quality investing is boring by design. When investing feels exciting, risk is usually being mispriced. Elite investors distrust excitement. They seek simplicity, repetition, and processes that can be executed consistently. Boredom to them is not a lack of stimulation, but a sign that systems are functioning properly and emotions are not hijacking judgment. Losses, when they occur, are processed methodically. The best investors do not ask, "How could I be so stupid?" nor do they externalize blame. They ask whether the loss came from bad luck or bad process. If it was bad luck within a sound process, they accept it fully and move on. If it was bad process, they dissect it ruthlessly and adjust. This distinction prevents emotional scarring, which is one of the most dangerous hidden costs in investing. Scarred investors become timid at precisely the wrong moments. Time horizon is another psychological lever. The best investors deliberately extend their time horizon beyond that of the crowd. This immediately reduces competition and emotional noise. Short-term thinking amplifies volatility and stress. Long-term thinking dampens both. By aligning decisions with longer horizons, elite investors create psychological breathing room. What looks like chaos in the short term often resolves into pattern and order over longer spans. Self-awareness is perhaps the most underappreciated mental skill. Great investors know their own weaknesses. Some are prone to overconfidence, others to hesitation. Rather than trying to eliminate these traits, they design systems to compensate for them. Checklists, position sizing rules, and pre-commitments exist not because they lack intelligence, but because they respect their own psychological limitations. This humility is not weakness, it is strategic realism. They also guard their information diet carefully. Constant exposure to news opinions and market commentary destabilizes thinking. The best investors consume less information, not more, and they consume it slowly. They prioritize signal over noise, depth over immediacy. This selective intake preserves mental clarity and reduces emotional whiplash. A calm mind sees patterns that an overstimulated mind cannot. Perhaps the most important lesson from the best is that the mental game never ends. Experience does not eliminate bias, it merely changes its form. Success introduces new psychological risks, complacency, identity attachment, and fear of losing status. The best investors remain vigilant against these forces, knowing that markets punish arrogance regardless of past achievement. They approach each decision with respect for uncertainty, even after decades of success. Ultimately, the mental game of investing is about alignment, aligning ego with process emotion, with probability, and action with patience. When this alignment is absent, even the smartest strategies fail. When it is present, even simple strategies can produce extraordinary results over time. And it is precisely at this point where most people start looking for techniques instead of examining their inner responses to risk loss, boredom, and uncertainty, that the real work begins, because understanding the mental game intellectually is easy. But living it consistently under pressure is where the separation truly occurs. And it is from this unresolved tension between knowing and being, between insight and execution, that we must continue. Because what comes next is not about theory, but about how the best investors train, protect, and harden their minds over years and decades, and how they build psychological systems that function even when emotions are loud and clarity is scarce. And it is exactly here, mid-thought and intentionally unfinished, that the journey must move forward as the sentence continues. And this is where the craft of mental training truly begins, because the best investors do not rely on motivation or insight alone to remain disciplined under pressure. They build structures that protect their psychology when willpower inevitably weakens. They understand that the mind left unguarded will rationalize almost any action when fear or greed becomes intense. So they design external constraints to compensate for internal volatility. Rules, routines, and pre-commitments are not signs of rigidity, but of self-knowledge. One of the most powerful tools they use is pre-decision. Before capital is deployed, elite investors decide in advance how they will behave under specific conditions. They define what would invalidate a thesis, how much pain they are willing to tolerate, and at what point they will exit regardless of emotion. By making these decisions when calm, they remove the burden of choice when stress is highest. This dramatically reduces impulsive behavior because the decision has already been made by a clearer version of themselves. Another cornerstone is journaling not as a diary of emotions, but as a record of reasoning. The best investors write down why they made a decision, what assumptions they relied on, and what risks they might be underestimating. This practice creates accountability across time. When outcomes unfold, they can compare reality with expectation learning, whether errors came from faulty analysis or unavoidable randomness. Over years, this habit sharpens judgment and weakens hindsight bias, one of the most corrosive psychological traps in investing. They also train themselves to endure discomfort deliberately. Just as athletes stress their bodies to build resilience, elite investors stress their psychology in controlled ways. They hold positions through volatility within predefined risk limits. They practice doing nothing while markets scream for action. They sit with uncertainty without seeking premature resolution. This exposure builds emotional tolerance, making future stress less overwhelming. Over time, what once felt unbearable becomes manageable, and clarity persists where others panic. Environment design plays a critical role. The best investors are intentional about where and how they work. They minimize distractions, reduce exposure to constant price movements, and limit social reinforcement that could distort judgment. Many avoid real-time market feeds unless necessary, because they know that constant stimulation amplifies emotion without improving decision quality. By shaping their environment, they shape their mental state, preserving the calm required for rational thought. Another subtle but powerful discipline is perspective management. Elite investors regularly zoom out, reviewing long-term data, past cycles, and historical analogs. This practice reframes current events, preventing the present moment from feeling uniquely catastrophic or euphoric. When everything feels unprecedented, fear spikes. When everything feels familiar, fear subsides. History used properly is not a prediction tool, but a psychological stabilizer. They also invest in relationships that support mental discipline. Trusted peers who value process over performance provide reality checks when emotions run high. These relationships are chosen carefully because the wrong social circle amplifies bias and reinforces poor behavior. The best investors avoid echo chambers and seek out thoughtful dissent, knowing that disagreement, when grounded in respect and evidence, is a gift rather than a threat. Rest and recovery are treated as strategic assets, not indulgences. Mental fatigue erodes judgment long before it feels like exhaustion. Elite investors protect sleep, physical health, and time away from markets, understanding that clarity cannot be forced. Breaks are not escapes from responsibility. They are maintenance for long-term performance. A rested mind sees risk earlier and opportunity more clearly. Over decades, these practices coalesce into something that looks like intuition. Outsiders marvel at the calm and decisiveness of great investors, mistaking it for natural talent. In reality, it is the result of countless small disciplines repeated consistently. The mental game becomes less reactive and more reflexive, guided by principles rather than emotion. In the end, the lesson from the best is sobering and empowering. Mastery of the mental game does not come from eliminating fear, greed, or doubt, but from building systems that prevent those emotions from dictating action. Investing will always involve uncertainty and stress. The difference is that elite investors expect this, prepare for it, and refuse to let it derail their process. And so the journey resolves not with a secret technique, but with a commitment. A commitment to self-awareness, to discipline over impulse, and to long-term alignment between thought and action. Those who embrace this mental game stop searching for certainty in markets and start cultivating stability within themselves. When that shift occurs, the market becomes less an adversary to be conquered and more an environment to be navigated calmly, patiently, and with respect. If this exploration of the mental side of investing has resonated with you, I invite you to subscribe to the channel and continue these deep reflections together, and leave a comment sharing which psychological habit or discipline you believe would most improve your own investing, because insight only becomes edge when it is practiced consistently over time.